Welcome to Breakaway Funding's October webinar. Thank you for coming. We hold these webinars once each month, bringing you valuable information on a variety of subjects, from using crowdfund investing in your self-directed IRA to investing fundamentals for the 21st century. We hope you enjoy them, and we'll make our webinar series a recurring event on your Google or Outlook calendar. A little about Breakaway Funding. Breakaway Funding is a complete capital raising and investing ecosystem, providing investors comprehensive and transparent due diligence documentation, analysis tools, and the technology platform for you to make informed investment decisions through a secure, convenient, and regulatory compliant website. Good morning. My name is Kim Kaselionis. I am the former CEO of Circle Bank, which I built and operated for nearly 2 decades, and I am the founder and managing partner of Breakaway Funding, which was created to step into the void in the private capital market by bringing together investor-ready entrepreneurs and community investors like you. Because of the opportunities introduced by the Jobs Act of 2012, we believe that crowdfund investing provides a clear path to sustainable economic growth through partnerships between investors, entrepreneurs, and local financial institutions. We are excited that you have decided to learn more about what opportunities crowdfund investing awaits you. To help set your expectations, I will be talking for about 25 minutes, bringing you an overview of crowdfunding, followed by a few examples of current crowdfund investment opportunities available on the Breakaway platform. After which, I will introduce our guest speaker today, who will be sharing with you how you can invest in crowdfunded securities in your self-directed IRA account. We will stop for questions after each presenter, so please feel free to send your questions in at any time during our presentation. To ask a question, use the conversation box on the right-hand side of your screen. We will get to as many questions as possible during the presentation. A message from our attorneys. I am not a licensed advisor. The opinions and information contained in this material is based on sources believed to be reliable and are written in good faith, but no representation or warranty expressed or implied is made as to their accuracy or completeness. Now let's get started. So what is this thing we call crowdfunding? Well, simply put, crowdfunding is defined as when a group of people combine their economic power to support a project, organization, or company they believe in, usually via the internet. And we talk as if crowdfunding is new, and it is not. We have some very cool technology today, but it is the way organizations and projects have been financed for hundreds of years. Let me give you a few examples. In 1872, when Congress was debating how to fund the $300,000 cost to construct the pedestal on which the Statue of Liberty would sit, to no avail, Joseph Pulitzer, outraged and frustrated, appealed to the American people and said, "Give me whatever you can." To incent larger contributions, he offered to send contributors of $25 or more a miniature replica of Our Lady Liberty. This gift, in exchange for a contribution, is now known as rewards-based crowdfunding. Amazingly, he raised nearly $100,000 within a 5-month period by aggregating the small dollar amounts from a large group of people. In another example, Benjamin Franklin wanted to purchase a printing press, but did not have the capital to do so. So he went door-to-door pre-selling subscriptions, aggregating small dollar amounts from a large group of people to accumulate the funds necessary to purchase the printing press. This pre-sale of a product is also known as rewards-based crowdfunding. There are 4 different crowdfunding models: donation and rewards-based, which are not regulated by any governmental agency, and then there is debt and equity crowdfunding, which are considered securities and therefore regulated under the Securities and Exchange laws in this country. Debt and equity crowdfunded securities are the subject of this presentation, and in which you will be able to invest in your self-directed IRA or 401k accounts, as Lamar will explain later. I will briefly describe each. We are all familiar with donation-based crowdfunding. The donor makes a contribution with no expectation of economic return. The challenge for entrepreneurs trying to use this model is that donors have difficulty contributing to for-profit companies. Therefore, this model is predominantly used by philanthropic causes. We have previously discussed rewards-based crowdfunding. In this model, the donor contributes cash and in return receives some kind of tchotchke, which value is close to the amount contributed. Rewards-based crowdfunding is great for companies who want to get market feedback on their product, but again, generally speaking, not a place where entrepreneurs can raise significant amounts of capital. In debt-based crowdfunding, the contributor, known as an investor, steps into the lender role just like a bank. The investor lends to the company money with the expectation of future repayment of their principal with or without interest on a fixed schedule. For investors, this is a great way to supplement your income because you have a known exit, as loans have a maturity date, the date at which the funds are to be repaid in full. If you are investing in debt-based crowdfunding securities in your self-directed IRA, those interest payments are tax-deferred, meaning you don't pay taxes when the interest is earned. Please talk to your financial advisor or CPA for more details about the tax status of your retirement accounts. In equity-based crowdfunding, investors contribute cash and receive equity instruments or profit-sharing arrangements and participate alongside the founders in the future success of the company. The primary benefit of becoming an equity investor is that there is no upward limit to what you can earn, assuming the company does well. This slide gives you a sense of what has been happening in recent history, from the Irish Loan Fund in the 1700s to Kickstarter in 2009. What is important to note here is that between 3 different crowdfunding or peer-to-peer platforms, nearly $8 billion in activity has been transacted since 2006. So where does crowdfunding fit on the funding continuum for companies? Well, depending upon the type of crowdfunding model used, anywhere from the prototype to the startup phase. But the beauty of crowdfunding is that it can be used by entrepreneurs at any stage of their growth life cycle. Now, as I mentioned earlier, because of opportunities introduced by the Jobs Act of 2012, we believe that crowdfund investing provides a clear path to sustainable economic growth through partnerships and engagement by investors, entrepreneurs, and local financial institutions. Let me explain why. The securities and exchange laws in this country define who can invest in private equity capital, meaning privately held companies. It is those very companies that have the potential to not only create jobs in this country, but also who produce some very exciting and very attractive returns. Just think, at one time, Google, Facebook, and Twitter were all privately held companies. Imagine where you would be today if you had had access to those early investment opportunities. So how did the Jobs Act come to pass? Well, think back to where we were in 2011 and 2012, the Great Recession or financial crisis, as it is called, characterized by high unemployment, capital markets through which companies depend upon investments to grow, expand, and create jobs were non-existent, and a time where we had a presidential election. Someone looked around the country and noticed there was $17 trillion in cash sitting idle in American retirement accounts. And they noticed that this cash didn't necessarily belong to the pension funds or big institutional investors, rather that it belonged to us, the average American. That was a lot of money sitting on the sidelines that could be used to invest in private companies to help jumpstart the U.S. economy. The only problem was, because of securities and exchange laws, the average American was precluded from investing in private equity securities. And who can change the laws? Well, Congress, of course. And thus the Jobs Act of 2012 was born. And the Jobs Act does several things, many of which I'm not going to get into today, with the exception of Title III, what we like to call the American Angels Act. This is the provision which grants all Americans the opportunity to invest in privately held companies, a luxury that until now has been reserved for the wealthy few. Title III does 2 primary things. First, it defines the parameters under which unaccredited investors can invest in privately held companies. The investment thresholds are based on your income level, as are other securities laws. If you earn up to $100,000 a year, you will soon be able to invest the greater of $2,000 or 5% of your income, so between $2,000 and $5,000 every 12 months. If you earn $100,000 or more, you will be able to invest up to 10% of your income, up to $100,000. The second provision of Title II defines the parameters under which private companies can raise up to $1 million per year from an unlimited number of unaccredited investors. This is very exciting, as it will now enable companies to bypass the gatekeepers of capital and go straight to their communities for the necessary capital to grow and prosper. And while the law was passed in April 2012, the SEC has yet to release the Title III regulations. Because of that, many states, including the state of California, which introduced AB 2096 in February, have taken matters into their own hands and have begun passing intrastate crowdfunding investment exemptions. This slide shows you how many other states are in the process or have passed crowdfunding exemptions. So let's talk about who can invest in securities-based crowdfunded investments. There are basically three categories of investors as defined by federal and state securities laws. Accredited investors, top of the food chain, qualified investors, for California only, a large contingent between the accredited and non-accredited group, and non-accredited investors. Who can invest is driven by the type of security exemption selected by the company raising capital. This information can be found in the offering document. A quick description of each of these three categories. Accredited investors are those who earn $200,000 a year individually or $300,000 jointly, or have net worth excluding the equity in their home of $1 million. This group represents about 2 to 3% of the American population, and statistics show that only half of accredited investors are active in the private capital markets. Qualified investors are characterized as those that earn $100,000 or more per year and have net worth excluding the equity in their home of $250,000, or net worth of $500,000 or more, again excluding the equity in their primary residence. In California, and particularly in the San Francisco Bay Area, this is an enormous untapped group of prospective investors for entrepreneurs desiring to raise capital. Finally, non-accredited investors, which describes everyone else who doesn't meet the accredited or qualified investor. And as we have discussed, Title III of the Jobs Act of 2012 was specifically created to allow this group, the 99%, to legally participate in private equity. There are many benefits of crowdfunding, from no fees to join a platform in order to seed deal flow, to portfolio diversification, ease of identifying, reviewing, and investing, opportunities to learn or to get the wisdom of the crowd, freedom to invest in companies that mean something to you, or the ability to own these investments in your IRA or 401k account. Crowdfunding is flexible and makes available much of which has been kept secret from the average investor. Investing, irrespective of what type, whether stocks purchased through the New York Stock Exchange, commodities, or bonds, involves risks, and private equity investing is risky. So be sure you read the business plans and other due diligence documentation and ask questions. Access to good information and high-quality market data, interactive sensitivity analysis tools, and the wisdom of others can help you in thoughtful investment decisions. Something else to consider when choosing a crowdfunding platform is where you, as an investor, are going to get the most protection. That is, which platforms are operating with standards that are consistent with the regulatory and industry best practices and being offered through a FINRA licensed dealer or in compliance with the Securities and Exchange laws. Not all crowdfunding platforms are created equal. At Breakaway Funding, all of our equity raises are conducted through a registered broker-dealer, someone who is licensed by FINRA. Everyone looks at investing through different lens or through different filters. Before making any kind of an investment decision, it is important to understand how you look at investing. This may make it easier for you to choose between various investment opportunities. What levels of risk are you comfortable with? Are you looking to make investments that have social impact? What are your emotional behaviors? What terms of investments are you looking for? What are your short and long-term liquidity needs? What is the risk versus reward you are comfortable with? As we've discussed previously, in addition to understanding your investment filters, having access to comprehensive due diligence is equally important, As former bankers, this is what our due diligence looks like. Now let's take a look at a couple of investment opportunities currently available on the Breakaway Funding site to see if they match your investment objectives. Our review will not do them justice. Therefore, you are encouraged to listen to their previously recorded investor pitch, which can be found on the blog section of our website and which we will send to you via link after the webinar. For those of you who live and work in the San Francisco Bay Area, perhaps you remember Cadillac Bar and Grill, located south of Market, the place to be in the 1980s and 1990s. During the height of its popularity, the Cadillac was displaced by the Moscone Center. Today, Michael is bringing the Cadillac back. He has a lease in the Twitter building, a great location characterized by high density, close to the public transportation, and in an area in which there are significant tax breaks. Michael is raising $1.5 million in debt and equity. You have two options to invest. There is a $60,000 minimum investment for equity and a $10,000 minimum investment for debt. The debt offering is for 3 years at a 12% annual interest rate. If your investment filters includes competitive returns, investing locally, and a desire to help create jobs and stimulate the economy, then perhaps becoming a part of the ownership culture of Cadillac Bar and Grill is for you. For more information about this offering, please go to breakawayfunding.com/Cadillac. Our next opportunity is E2 Lighting. E2 Lighting specializes in the marketing and sales of LED lighting for residential, commercial, and industrial markets, offering a one-to-one retrofit energy solution. Their product provides more than an 85% savings compared to traditional lighting, and which lasts 20 times longer. The LED industry is a $50 billion disruptive technology that's subsidized by the U.S. government. It is estimated that LED will capture 60% of the global market in the next 5 years. With nearly $3 million in sales in the pipeline, E2 is raising $1 million capital for inventory and operations through traditional debt securities. The term of the debt is 5 years. It pays a 10% interest rate, and there is a $5,000 minimum investment required. Additionally, they are offering a 10% discount of all lighting products for investor personal and business needs. If your investment filter includes clean energy, creating jobs for the local economy and long-term income, perhaps an investment in E2 Lighting is for you. Finally, Functional Foods Technology of San Francisco. FFT produces a slow-carb, low-glycemic line of bakery products designed with significantly more protein and fiber, less sugar and carbs to provide sustained nourishment for diabetics, and which helps to eliminate cravings and overeating. There are over 100 million obese diabetic and pre-diabetics who have gone ignored and underserved. This is a $20 billion market for potential goods in this category, $1 billion low-carb and low-glycemic diabetic safe food market, and a $5 billion gluten-free market. 1% of this market equates to $60 million in revenue potential for FFT. The term of the offering are convertible notes, meaning that the investments will accrue interest, and at the time of the next raise, your investment will be converted into equity. The minimum investment for the FFT is $1,000. If your investment filters include helping to provide options for diabetics and others by providing healthier food snacks, having access to huge market potential, and owning a company that is very scalable, then perhaps an investment in FFT is for you. That brings us to the end of my presentation about crowdfunding and examples of investment opportunities for your consideration, which opportunities you can now invest through your self-directed IRA. I will take a few questions and then turn it over to our next speaker. And our first question is from Devin. Devin asks, when will non-accreditors be eligible to begin investing? Well, fortunately, Devin, you can begin investing today. What determines who can invest is the type of security exemption the company has chosen to raise money. You can conduct a quick check by clicking on the qualification tab under each investment tombstone on our website for a detailed description of which investors are eligible to invest in any particular investment opportunity on the Breakaway platform. Great question. Our next question comes from Carol. Carol asks, can I invest in my IRA through your website? Great question, Carol, definitely. Once you've registered as an investor, all you need to do is set up your trading account. This will enable you to transfer funds from another institution through which you can purchase or make your investments in one or more opportunities on the Breakaway site. You can set up your self-directed IRA on our platform, or of course you will be able to talk to our guest speaker, Lamar Baxter, who will be joining us shortly. That is all the time we have for questions. If you did not get your question asked, please feel free to contact me at Kaselionis at breakawayfunding.com. That's KKASELIONIS at breakawayfunding.com, or call me at 415-729-9482. Again, that's 415-729-9482. It gives me great pleasure to introduce to you our guest speaker, Lamar Baxter. Lamar graduated from the University of Phoenix with a Bachelor of Science in Business Marketing. In addition to specializing in self-directed retirement accounts, he is knowledgeable in residential and commercial mortgages, land banking, commercial lending, alternative investments, private placement investments, and structuring investments, capital raising, and crowdfunding. He has previous experience in commercial leasing, asset management, accounts receivable factoring, and private note loans secured by real estate. Lamar regularly conducts educational seminars outlining the benefits and rewards of investing in real estate and other alternative asset classes with self-directed retirement accounts. With over 27 years of financial experience, he is able to provide his clients, business partners, financial professionals, real estate professionals, and investors with the tools required to invest in real estate-related transactions and other alternative investments using self-directed retirement accounts. Lamar, it's great to have you with us today.
Hello, everyone. My name is Lamar Baxter with Accuplan Benefit Services. I am the Director of Business Development. Today's topic, we're going to be covering crowdfunding with a self-directed IRA or 401k. Today's topic will cover how you use a self-directed retirement plan, whether it be a self-directed IRA or 401k, to make alternative investments. Today's information will be in the context of educational information only. It's not designed to endorse or promote any particular investment. It's pretty much designed to give you an idea how to use this powerful investment tool to make alternative investments outside of your traditional stocks, bonds, and annuities and everything else that's offered as it relates to Wall Street investments. Once again, my name is Lamar Baxter, Director of Business Development, and basically cover all of Northern California, educating both individuals as well as other professionals relative to using the self-directed plan. I have over 28 years of very financial experience covering every area of investment as well as different types of investment structures. So a lot of information that we cover as relates to the self-directed plan. If you have any questions outside of what we're going to cover today, feel free to give me a call, and I'll be happy to answer any questions that you may have. Just before we get started, just going to read our disclaimer. As I mentioned just a second ago, all of our information is for educational purposes. It's not designed to endorse or promote any investment products. So with that being said, I'll go ahead and read our disclaimer. Accuplan Benefit Services and its affiliates do not promote or provide any investment advice or endorse any products. All information and materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, financial advisors before entering into any type of investment. So basically, you want to make sure that you're taking an active role in terms of vetting the investment, checking out the investment itself, as well as the investment offer before you move forward on any investment. So before we get started, what we usually want to do is kind of give you an idea of who we are. Accuplan is a self-directed plan administrator. Our parent company is American Estate and Trust, and basically take on two roles when it comes to handling your self-directed plan. Accuplan handles the administrative, meaning all of the paperwork, the IRS reporting and record keeping. Our parent company, American Estate and Trust, pretty much covers the handling of all of your assets and the holding of any of your cash, which we're a licensed custodian in the state of Nevada. So if you want any additional information on Accuplan and American Estate and Trust, feel free to give me a call or send me an email. Our staff consists of very financial professionals, including one of our staff members who's a retired member, or retired party from the IRS. So we usually try to make sure we're up to speed when it comes to any type of rules and regulations. They're going to make sure that your investment transactions are compliant. So one of the things we like to cover before we get started is why are most people considering the self-directed plan? Well, these bullets which pretty much outline why a lot of our clients have opted to go with alternative investments using the self-directed plan. It is estimated that 10,000 baby boomers per day will turn 65 for the next 18 to 20 years. Of that segment of the population, up to 75% of the baby boomer population do not have adequate resources to retire at the age of 65 and beyond. So at this point, we're basically saying take an active role, take a proactive role in terms of basically growing your retirement account, looking at both non-traditional and traditional investments. Most will be forced to continue to work after the age of 65, provided that their occupation will allow such. Retirees will be facing skyrocketing healthcare costs and diminished Social Security benefits. So a lot of the benefits that we've, say previous generations have taken advantage of in the past may not be there for existing and upcoming generations. So it's really important to look at other alternative investment options to grow your retirement plan. And of course, we have to factor in inflation and cost of living increases that will also threaten to erode any fixed retirement income that you're expecting in your later years. It is estimated over $4.7 trillion in combined IRA and 401k funds are out there for self-directed investment, but only 1% of that $4.7 trillion is actually being used for alternative investments using a self-directed plan. So what we're going to basically cover today is a self-directed plan and when you want to use and what your investment options are. Is estimated up to 70% of the population is unaware that the self-directed plan exists. That would include your attorney, your accountant, your financial planner who wasn't actually trained in this area of the tax code. So it's not to say that they do not know the information. It's kind of with any product or service, they pretty much focus on the areas that they cover. In addition to your financial planners and some of your accountants, your current custodian may not offer a truly self-directed plan. So usually the test or the question to ask if you're being told that you have a self-directed plan is, are you available to invest directly into such as assets such as real estate? Can your plan hold anything outside of stocks, bonds, annuities, and some of your other traditional investments? If the answer is no, you may not have what's called a truly self-directed plan. The only restrictions you have with a truly self-directed plan is that you cannot invest in life insurance and collectibles. And we'll talk about some of those prohibited transactions in some future slides. So what we're going to do is we're going to talk about diversification real quick. Well, it's important that in any investment portfolio, whether it be just your investment portfolio outside of retirement funds, you want to make sure that your portfolio is truly diversified. So as I mentioned, $4.7 trillion in assets, most invested in Wall Street. Well, what we're basically saying is if you're looking to truly diversify your investment portfolio, you want to be looking at both traditional and non-traditional investments, and that's definitely where crowdfunding comes into play. It is considered an alternative investment where you are able to invest in a wide range of investment options, and we'll talk about some of those options that can also be included under the umbrella of crowdfunding. The majority of those funds are invested in mutual funds and some of your brokerage firms. So once again, we're looking to basically change the mindset of the retirement custodian, or should I say the retirement account holder, to make sure that they are aware that there are other investment options out there other than Wall Street investments. Our motto in the self-directed IRA industry is invest in what you know and understand. The captions here basically reflect the more common transactions that are being taken advantage of by some of our account holders. Not to say that this is a total list, but these are, I would say, the four popular topics, or should I say, investment categories that our clients are taking advantage of. And of course, any four of these categories could be included in crowdfunding depending on the platform and how the platform is set up. So what we're going to do is look at some of the investment choices. As I mentioned, the only restrictions that you have is life insurance and collectibles. So if you kind of look at this list to get an idea in terms of what your investment options are, I'm sure if you were to contact your traditional custodian that are basically holding just Wall Street or traditional investments and ask them, are you able to invest in any of the investment classes listed on the screen here, I'm sure the answer would be no. So once again, the true objective is to be able to diversify your investment portfolio. The self-directed retirement plan offers you the ability to invest in both traditional and non-traditional investments. So if you're ever told by your planner or your existing custodian that you're basically restricted from investing in traditional investments, with the self-directed plan, you have the best of both worlds. So we're going to move forward here. We talk about prohibited transactions. There are restrictions in terms of what you can and cannot do with this plan. And in order to make sure that you maintain a compliant retirement account without any tax or penalties. These are some rules that you must be aware of and must follow. The IRA cannot engage in any transaction directly or indirectly with anyone or anybody in terms of relating to the IRA. So basically they're stating that you cannot take personal possession of any assets as long as the assets are owned by the IRA. So if you're basically looking to invest in something such as real estate, when they say no immediate benefit, meaning that if the IRA or the retirement plan holds the asset, you would have to actually take a distribution or basically transfer the asset out of the retirement plan to yourself, which will be taxed and penalized depending on your age that you take the distribution in order to enjoy the benefits once owned by the asset once owned by the IRA. So once again, you want to make sure that you follow these rules. So some of the examples would be of a prohibited transaction between a disqualified person. We'll talk about a disqualified person on the next slide. It's selling and exchange of any goods or leasing property, lending money, any of the transactions you would take advantage of where you're basically dealing with the retirement plan, yourself, and other disqualified persons. So to get a better idea in terms of who's a disqualified person, let's take a look at this list here. Disqualified person would include yourself, your spouse, parent, grandparent, children, or grandchildren. So in addition to the prohibited family members, you also want to look at any fiduciary of the IRA. So that would be inclusive of an attorney, CPA, or a real estate agent who's maybe working directly with you on a transaction. If they have any type of fiduciary capacity over your transaction, they're restricted to going to business with you using the retirement plan. In addition, anyone providing services to the IRA, so that would include myself as a custodian. I would be restricted from working with any of my clients relative using those retirement funds for any particular investment. Corporations and partnerships. So if you actually have a business and you're looking to invest in a business, as long as you follow the rules that you do not have more than a 50% stake in the business and have controlling decision-making powers in that organization, you may be allowed to use self-directed plans to invest in a business that you currently own. For more information on that, you definitely want to consult with your tax professional or CPA to get a better understanding in terms of the structure of the transaction that you're considering to make sure that it's compliant. So what we're going to do is basically, we just pretty much covered the prohibited transactions in a nutshell. So once again, you really just want to make sure you follow those rules. If you have any questions or want more information on what those rules are, I'd be happy to email over IRS code 4975, which is the actual tax code that basically oversees the self-directed community, or should I say retirement community, in terms of what you can and cannot do. I'd be happy to provide that information to kind of give you a better idea as you start to consider your investment decisions in terms of what your limitations or restrictions may be. So once the plan is established, how do you actually fund the account? So the four methods that you have available to you to be able to fund your account is via transfer, rollover, contribution, or conversion. So let's take a look at transfer. The transfer of funds usually involve moving funds from an existing IRA over to your new self-directed plan. That is a non-taxable event, so what it involves is completing a transfer request form. Those forms basically being processed, and within 7 to 10 days from the time that your existing custodian receives the request, they will disperse the funds via cash or via wire or via a check, depending on whichever method that you choose. Once again, the process takes approximately 7 to 10 business days. A rollover usually involves the moving of funds from an employer-sponsored plan or 401k. Usually what you're going to do is once the plan is established, you're going to provide them with the IRA vesting or the retirement account vesting. They will have you complete their internal forms, and within 7 to 10 business days on average, usually they will disperse the funds either directly to us as your new custodian or directly to you, payable to your retirement account custodian. Then you would then basically forward those funds into us to deposit into your account. The contribution is basically, depending on type of plan that you're actually eligible for, will allow you to make out-of-pocket contributions into your plan. And usually up to a certain dollar amount based on whether you're employed or 1099, or so say employed or a W-2 individual, will determine what type of plans that you're available or eligible to actually open. And we'll talk about that on the next slide. The conversion usually will involve basically moving funds from a tax-deferred account over to a Roth account. So with the tax situation in our country basically looming, not knowing where the tax rate is going to be in the future, some of our clients are considering taking a 401k or the tax-deferred retirement plans and converting those funds into a Roth. The benefits of making a conversion over from a tax-deferred account to a Roth is that after you've had the account for 5 years and you are at least 59 and a half, you can pull out all growth tax-free. So that is something that's really attractive and gaining a lot of momentum as it relates to our account holders that are looking to basically avoid taxes in the future. So we're going to talk about the different types of plans. We talked about the contribution limits, or should I say we talked about the different types of plans or the methods of funding the different type of plans. So look at the type of plans that we have. A lot of these plans may be familiar to you because they are pretty much the same type of plans that you may or may not have with your current custodian. Keep in mind a self-directed plan basically gives instruction based on the plan agreement in terms of what restrictions or not that the plan has available to the account holder. So pretty much the same plans that you currently have now is what we offer, but they are truly self-directed, meaning that you have a wider range of investment options and choices. So starting with the traditional IRA, it is an individual retirement account designed for those who are individual, whether you're 1099 or W-2. It is a tax-deferred account. You can contribute up to $5,500 per year, and you have a catch-up contribution limit of an additional $1,000. So basically, if you're over 50 and a half, you can contribute an additional $1,000 per year, totaling $6,500. Now, what you want to make sure, when I say up to on all of these categories, we're talking about required what we call a earned income allowance. So basically, what you want to do is contact your CPA or tax professional to determine, based on your taxes, or I should say your income for that particular year, what is your contribution limit up to the limit of the plan. You may not necessarily be able to contribute the full maximum depending on what your earned income is for that year, so you definitely want to make sure you're communicating with your tax professional on an annual basis before you make a contribution, because the penalty for an excess contribution is 6% of the amount that goes into the account that's not allowable if you basically exceed a certain threshold for its income. The Roth, pretty much the same as a traditional IRA, an individual retirement plan also. The difference is this is can be a tax-free account, meaning that as long as you've had the Roth for at least 5 years and you're 59 and a half, you've met both milestones when you pull the funds out, you pay no taxes on any of the growth. Now, if you're converting funds from a tax-deferred account to a Roth, you pay your taxes at that time. So the benefit is to pay taxes at today's tax rate opposed to a higher tax rate in the future, and do not pay any taxes on any growth once you've met the 2 milestones of 5 years and 59 and a half. And the contribution limit catch-up is the same as the traditional. You have a $1,000 catch-up if you're the age of 50 and a half, totaling up to $6,500 for that tax year. The SEP IRA is for those who are 1099 or self-employed. It's a tax-deferred account. It's for those who do not have a W-2 income and opt to basically open a retirement plan on their own. They have the ability to contribute up to $51,000 into that plan, and that grows tax-deferred. For more information on that, feel free to give me a call. The simple IRA is for the smaller business, usually with 100 employees or less, where you basically, it's almost comparable to a 401k, but a little simpler than a 401k. It's designed for a small business, once again, with 100 employees or less, to where you can contribute tax-deferred up to $12,000 per year into that plan. Now, the most popular plan out there right now for those who are, once again, 1099 or self-employed, and this usually where the contrast comes between the SEP IRA and this one plan called the 1K or Solo K, contribution limits are the same, contribution up to $51,000, and you have actually the ability to contribute into 2 buckets into this plan. One as the employer, up to $14,500, or should I say as employee, $14,500, and the balance as an employee up to $51,000. So once again, you want to consult with your tax professional to determine whether this plan versus a SEP is best for you. One of the benefits of a Solo K versus a SEP IRA is that, as like with any 401k, you have the ability to borrow from that plan. Any IRA, you cannot borrow from the plan, but a Solo or 401k, you can actually borrow from. So that is one of the added benefits. That if you're kind of in the crossroads determining whether you want to go with a Solo K or a SEP IRA, is one of the added features that you can borrow. In addition, if you're looking to take out any type of leverage financing used in a retirement plan, this Solo K is actually exempt from what's called unrelated debt finance income tax. And we can talk about that if you have any questions in terms of what that is. We have just enough time to cover this topic, but if you want more information on that benefit and the exemption as it relates to leverage financing, feel free to give me a call or send me an email. So So the next slide here, we're talking about different types of investment structures and options. So partnering with an LLC is one of the more common methods or additional features that's used with the self-directed plan. It's for those who are usually looking to establish a partnership in an inexpensive way, whether using other retirement funds or using actually personal funds of their own, provided structured properly, and it's no partnering with a situation to where the asset is previously owned by the IRA or the other individual. You can actually partner with an LLC with various partners or other retirement plans. Partnering via tenants in common, that's something that's usually done within real estate transactions. If you're looking to purchase real estate directly with a group of parties, it's less expensive than setting up an LLC, but once again, there are rules that must be followed. If you have more have questions relative to partnering and through a tenants in common, feel free to give me a call, and I actually have a PDF I can send over to you that explains what the rules and what the structure will look like. Non-recourse loan, not much relative to crowdfunding, but once again, it goes back to if you're looking to use leverage financing with a self-directed plan, a non-recourse loan is available. What that involves is basically your IRA receiving a loan, not you personally, but your retirement plan receiving a loan, and up to, depending on the lender, up to say 65% loan to value, they will grant a loan to the IRA. Your credit is not an issue because once again, if the loan is being granted, it's being granted to the IRA or the retirement plan itself. The New Deal exception is usually partnering with yourself or any other disqualified persons. Real briefly, as long as the asset is not previously owned by any parties, including the IRA, you can actually go into contract or to purchase an asset using this structure. For more information on that structure, once again, give me a call or send me an email. So what we're going to do is move forward in terms of wrapping this up in terms of how to actually invest in crowdfunding. We treat the crowdfunding platform or any crowdfunding investment as a private placement transaction, meaning that outside of investing in a crowdfunding platform, usually all we require is to establish the account, fund the account via transfer, rollover, contribution, whichever method or combination of all of the above, complete some of our internal forms, which includes a direction of investment and other authorization forms, and provide us with the required documents. Usually in a private placement, depending on the structure, what we're looking for is an operating agreement and or a subscription agreement and maybe even a private placement memorandum. So usually those are the three documents we usually require on any crowdfunding or private placement type of investment. For more information, give me a call or send me an email, and I could be happy to provide you that checklist. It's pretty straightforward, nothing really sophisticated about the structure. It's just an added platform with the crowdfunding that you're able to actually make an investment through that type of platform through various investment offerers. So pretty much what we're going to cover for today. So I'm just going to give you a quick overview in terms of how the process works using a visual. You're going to open your account, usually within the same day or within 1 or 2 business days, depending on whether you establish the account online or do it manually. We can have your account opened. The next step is once the account is open is you're going to transfer your funds from an existing retirement account, roll it over from an existing 401k or employer-sponsored plan, or make a contribution or all of the above to fund your account. Once your account is funded, you're now ready to move forward with the investment choice. So depending on whether you're investing in real estate, notes, private placements, metals, whatever the case may be, as long as it's not life insurance and collectibles, the sky's the limit. And usually within, say, 3 to 4 business days or 3 to 5 business days from the time we receive a complete investment packet, wiring instructions with no errors, we can actually fund your investment transaction. So that's pretty much in a nutshell what it would basically consist of in terms of investing in a self-directed plan through, or should I say investing in crowdfunding using a self-directed plan. So in summary, IRAs can hold all types of investments, not just securities. So you definitely want to look beyond just your traditional Wall Street investments. Partnerships and split ownerships are allowed depending on the structure. I'd be happy to answer any questions or to overview, should I say, oversee any type of investment scenarios that you are considering and let you know whether it's permissible or not. IRAs and solo Ks can grow tax-deferred or tax-free, so depending on the type of plan that you're seeking, consult with your tax professional to determine which is best for you, and we can offer whichever plan that you're eligible for. All plans qualify for partial and transfers and partial conversions are allowed. So what that means is, unlike a rollover, usually you're required to move all of the funds from a 401k over to your new plan. With a transfer from an IRA, you have the ability to move all or a portion of the funds. So just keep that in mind. If you're moving funds from a 401k, you're usually required to move all the funds. If you're looking to move funds from an IRA, you can move all or a portion. When it comes to conversions, not everyone wants to convert or can afford to convert monies from a tax-deferred account to a Roth account. So you want to make sure that you speak with your tax professional to determine what your tax liability would be as it relates to a conversion, and consider either a partial or full conversion over to a Roth plan. Self-directed IRAs play a critical role in crowdfunding and will continue to play a critical role moving forward, as self-directed funds are considered, the industry is now considering alternative asset or alternative cash to be considered for investment. Be sure to establish your fund and fund your account prior to entering into contract. It's really important that you establish the account to receive what's called an IRA or account investing to enter into contract. You cannot enter into contract under your name and then transfer it to the retirement plan. It's considered a prohibited transaction. So it's very important that you establish the account, even if you're considering the investment, to make sure that's in place, to make sure that your transaction remains compliant and tax-free. So that is pretty much my presentation for today. If you have any questions, here's my contact information. Feel free to give me a call, email me, or reach me on any of the social media, and I'll be happy to answer any questions you may have. I'd like to thank everyone for attending today's webinar, and once again, I look forward to talking to you in the future. Thank you.
Thank you, Lamar, for that very comprehensive overview of how investors can now use crowdfund investing in their IRA or other retirement account. At this time, we're going to open up the lines for a few questions. Okay, our first question comes from Steve. Steve asks, I hear somewhere that it's a good idea to move funds into my Roth IRA once my crowdfunding investment becomes profitable. What are your thoughts? And I know you can't give investment advice.
Well, as many are concerned about where the tax rates will be in the future, usually if one is determining that they're going to have a relatively high yield on their investment, usually the protocol is to establish a self-directed Roth account out the gate, and then at that point, as long as they've had the account for 5 years and they're 59 and a half, they can start pulling out the growth tax-free. However, you do have the alternative of being able to convert either cash or an asset over to a Roth account. Just a few more extra steps, and it can take up to 30 days to do so, depending on the structure of the investment, but you can actually convert it to a Roth. Usually the determination as whether you want to convert it to a Roth is based on what your tax situation is for that particular year, whether it's going to kick you into a higher tax bracket, whether you had a loss for that year. In most cases, if you have the ability to absorb the taxes and it not kick you into a higher tax bracket, you want to maybe opt to go the route of converting the assets and the cash to a Roth.
Excellent, excellent. Thank you very much. And our next question comes from Craig, and I think you may have already addressed this, Lamar, but let's have another review. The question is, how long does it take to transfer my funds?
Depending on the custodian, in terms of where your funds are currently with us, with an IRA or 401k custodian, usually the average turn time is 7 to 10 business days from the date that they receive the request. Usually it takes us, depending on how you want us to send the request over to them for a transfer, usually it takes a few days. If you want us to overnight it, we can overnight it. But normally 7 to 10 days from the time that your existing custodian receives the request in order for them to transfer the funds over to us via a transfer of the check or via a wire.
Fantastic. Well, we are about out of time at this moment. So if you have any additional questions for Lamar, please contact him at 916-509-7150 or at his email address at lamarbaxter@accuplan.net. That's LamarBaxter@accuplan.net. That brings us to the end of our webinar this month. We hope you have found this information valuable. But before we sign off, I would like to leave you with a few closing thoughts. If you had the chance to invest in Twitter, Google, or Facebook, where would you be today? Let's face it, like most of us, you probably would never have access to these opportunities. But today at Breakaway Funding, we are changing that paradigm. Like never before, you have the chance to get in early on opportunities that are meaningful to your portfolio, which opportunities have historically been denied you, and which now you can invest through your self-directed IRA account. I personally invite each of you to become part of the ownership culture of these and other very exciting companies raising capital through Breakaway funding. It's simple, it's fast, it's free, it's secure, and it's compliant. Sign up today at breakawayfunding.com and take advantage of being an early investor to these incredible investment opportunities. Please join us for any or all of our future events. Register at breakawayfunding.com/breakaway-events. Again, thank all of you for joining us today. Welcome to our investor community, and we look forward to seeing you next time.